Good Thursday morning, everyone. We're on the floor of the New York Stock Exchange with Kenny Polcari, a managing director at O'Neil Securities. All right, Kenny, we have this July 6th trade deadline.
Right.
No real earnings until then, light volume because of the holidays. Is this the perfect storm for a pullback?
Well, it could be a perfect storm, right? Because exactly right. There's going to be less people between this week and next week with the holiday in the middle of the week will cause a lot of asset managers just to kind of be away. You know, they'll set broad parameters, but the tight stuff will cause the markets necessarily to maybe have a reaction one way or the other. My sense is if the reaction comes, it's going to be more negative than positive because you've got not only trade tensions, you've got the Fed policy, you've got the tariff wars, you've got a weakening Europe, you've got all these other things that, although we've known all about them all along, the fact is when they start to accentuate the negative, they start to throw everything into the pot, right? So then the market comes under pressure, which is what you're seeing again right now.
So what do you do until then? Do you kind of sit on your hands, or if you have money to put to work, should you pull the trigger?
Well, I suppose it depends on who you are, right? If you're a long-term investor or a long-term asset manager, yes, you would look for opportunities like this to put some money into work in sectors that you've already done your homework on, that you like, that you understand may come under some pressure. Well, listen, you're going to the industrials have come under real pressure because of the trade talks, right? I actually don't think we're going to get a trade war, so I think they're overdone. But if you like them, you got to start to put some money to work. Doesn't mean you do it all at once, but you take your time. You look at some of the bigger names in it, ones that have especially gotten hurt in anticipation of this trade war. Since I don't think there's going to be one, I think you're going to see a bounce back. Certainly tech, any pullback in tech is going to be an opportunity. Financials, which are really struggling at the moment, have broken all kinds of support, are trying to find some stabilization in here. If everything calms down, and I'm going on the bet that everything's calming down, I think then you're going to see a lot of these sectors, rally right back.
And we're waiting those stress test results from the banks.
Yeah, but we already had part one last week, and it was stellar, and everyone passed it. I can't imagine part two is going to come out with a complete turnaround and say that there's all these problems. My sense is that the stress test part two is not going to be a major market mover.
What do you make of some of the intraday volatility we have been seeing, especially on, Wednesday,
right,
where we had the Dow swing up 460 points?
Well, I think that speaks exactly to kind of investor anxiety. More trader anxiety versus the long-term investor, because the long-term investor is a long-term investor. And so, they're buying it on the way down. They're not being so aggressive. It's the trader types and the algorithms that are causing kind of that intraday moves. And look, we're technically broken now, so that what was support has now become resistance. You're going to expect the market to go up and test it. If it fails, you're going to see the market sell right off again, which is exactly, I think, kind of what we saw in the S&Ps, the futures this morning. They rallied them hard. They took them right up to that resistance level, and now look what they've done. They've failed and they've backed off.
But the S&P 500 breaking below 2,700.
2,700 is psychologically, it's a round number, yes, and so that psychologically, it's kind of concerning, right? But 2716 and 2701 were the two trend line supports. The next one is the 200-day, which is really the longer-term support. That's at 2655. I have every reason to believe that we are going to test that, whether we do it today or not. It's only 30 points away from here, less than 1%, or just about 1% from where we are. Not necessarily out of the question.
But a test back to, say, 2581, what are the odds of that?
Well, 2581, that would be tough, because if we break 2665, which is the long-term 200-day support, then the real next level would be all the way down to 2581, which is the lows. And so that would be a little bit more concerning, I think, for the market, certainly for all these risk management software programs that are out there that all these asset managers use. It would signal, further weakness in the market. It would signal a market that was under pressure. And so then you'd start to get a change in psyche, right, in market psyche. I don't think that's going to happen. I think we are going to test at 200. I think it will be defended. And from there, I think the market will then start to stabilize and might remain there for a while until we get through the trade talks. But then I think that'll be the worst for now.
All right, so let's talk about that other side. What is the path to 2873? Will earnings season after July 4th, will that be enough to get the market back up to that level?
I suppose the answer to that question is, what are we hearing, right? What are we going to hear these CFOs and CEOs say about the impact of trade policy? Are they really concerned? Are they not so concerned? Are they going to do what Harley-Davidson is doing and offshoring? Going to move manufacturing facilities to Europe to avoid the tariffs? Because if they produce in Europe and sell in Europe, there's no tariff to pay. And so a lot of that's going to be very dependent on what we hear. I actually think that although some earnings estimates have been cut, some of them by 40 and 50% very quietly ahead of earnings season, I think, though, it's not so much going to be what the earnings are because they're history already. It's going to be what we hear about what these CEOs are saying about not only the economy, the European economy, but trade policy and the potential impact. That's what's going to drive the broader market higher or lower in the days ahead.
But a retest of 2873, that's the January 26 high, that would be monumental because that level was not supposed to be reached in January.
No, that's correct. And so if we break 2665, that means we've broken all three real trend line supports, which then, like I said, kind of puts a different, changes the psyche of the investor as well as the market. A test of 2581, although it could happen. 2873, although it could happen. 2873 is the high.
The high.
If you're talking on the low side, if it breaks 2665 down to 2571, that would be bad. 2873, it's going to be a long time before we get there. Because
this year, though?
I think we approach it. I don't think we're going to get back there, quite honestly, because I think the third and fourth quarters, the earnings are going to come down, and I think there's going to be more angst around midterm elections and a lot of chatter about geopolitical stuff. I think it's going to hold the market in check. So I don't necessarily think we're going to end the year there, but I think we're going to end the year higher from where we are.
All right, Kenny Polcari, we'll leave it there. Thank you so much.
Thank you.